Sorry. Allow me to share my screen here. Okay. All right. Okay. So let me today let us do another paper. Let me search for a paper here. FR past papers. Plastic same library. So that's how you can find papers. It's a matter of saying the paper you want. In this case, it's FR past papers. Make sure you also study all these past papers. They are instructive and authoritative on ACCA exams. So here you are. Where do we get FR papers? Past exam library. So here that's FR past papers, past exam library. And if we can have March-June 2019. March-June 2019. Let me send it to our WhatsApp group. March-June 2019. FR March-June 2019. Right. So there you are. Let me open it as well. You can open it in the meantime. Allow me to open it here also. All right. All right. Okay. So if we can finish this paper during today's revision, that would be great. That would be very much great. Let me open my Excel spreadsheet. Okay, so I'm sure my stuff is done. Allow it to open. For whatever reason, it's slowing down. Okay. So remember, this is revision. It means you'll be also contributing. It doesn't mean I will be doing the talking whilst you are just listening. No, 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 no. I expect everyone to contribute, you know, as part of our revision here. I expect everyone to contribute as part of our revision. So let me start with this. It says during the year ended 31 December 20x8, Lynette Kamban built an extension to its head office. The costs associated with the construction of the head office extension are as follows. So these are the costs associated with the head office construction. Land acquisition, 10. Fees for environmental certifications and building permits, 0.5. Architect and engineer's fees, 1 million. Construction material and labor costs, including unused material, 6.6. Meaning 6.6 includes materials that we didn't use. That's the key there. At 30 September 2008, the date when the head office extension became available for use, meaning it was constructed up to 30 September 2008, the cost of unused material was 0.5. At that date, the total borrowing costs incurred on a loan which was used specifically to finance the head office extension amounted to 0.8. So this 0.8 is borrowing costs. This is now borrowing costs or interest on the loan, so to speak. Lynette also acquired 100% subsidiary with Scully on 1 January 2008. The carrying amount of the assets of Scully in the consolidated financial statements of Lynette Group at 31 December 2008 immediately before an impairment review was like this. So as you can see, if Scully is a subsidiary, it means it is tested for impairment as a cash generating unit. So this is like the carrying amount of the cash generating unit. The recoverable amount of Scully was estimated to be 9.6. Notice carrying amount is 11.8. Recoverable amount is 9.6. And the impairment of the investment in Scully was deemed to be 2.2. Yeah, if you say 11.8 minus 9.6, you get 2.2. That's the 2.2 part of it. Right, now, question 16. For the year ended 31 December 2008, how much should be capitalized in respect of the construction of the head office extension? How much should you capitalize? Talk to your say. Information for that is it's in the paragraphs highlighted, just up to here. How much do you think should be capitalized? In the interest of time, let us be fast, guys. Let us be fast. We need to cover as much. You calculate and type in the chat feature. Remember, revision, you'll be also partaking. Without you partaking, it won't be that effective. Make sure you are being bound by time consciousness there. You type your answer in the chat. Okay. Well, so let me chip in and see. Oh, someone is typing. You know, I like to see you guys typing. At least this This is it gives me an ideal scenario. An ideal scenario is for me to see if you are also preparing. The only way I can see is through, concerning, your assignments on CBE practice platform. Some of them are due today. I understand you know that. Make sure you finish those before the due date. As soon as we are done, attend to end and finish, because the system will submit automatically. There's no way I can extend it. Once you've started writing, I can't extend. I can't change anything. All right. So you're saying it's 18,4 Tafara. Let us see. Let us see together. So all the other costs are capitalized, like land acquisition 10 plus environmental fee 0,5 plus architect 1, it becomes 11,5 plus 6,6. Then you take out unused material. So it will be 11,5 plus 6,6 minus unused material 0,5 plus capitalized borrowing costs 0,8. And what I'm getting is 18,4, correct? So you're correct with that. Now, next question says, Lynette incurred further expenditure on the head office extension after it had been completed. Meaning, there was completion. We are told that it was ready for use on 30 September 2008. But then, after it was completed on 30 September 2008, Lynette incurred further expenditure here. Which of the following would qualify as capital expenditure? Which of the following would qualify as capital expenditure on that further expenditure? After you have completed a building, what would qualify as capital expenditure? It's an easy question there. You have completed your building and you incur further expenditure. What would qualify? So you're saying it's B. I agree with you. I agree with you here, because if you complete a building and then you proceed to buy fixtures and fittings, that's capital expenditure. That's capital expenditure there. Are you not seeing that FRS is? These are the questions which your colleagues will be writing. At 31 December 2009, the directors of Lynette decided to adopt a revaluation model of IS 16 property, plant and equipment for Lynette's company's property. In accordance with IS 16, which of the following statements is false? If you are revaluing a property, which of the following statements is false? Right. Let me see. C. Correct. C is the answer. All the other points are wrong there. All the other points are correct. For example, if you revalue property, subsequent depreciation is based on the revalued amount. That's correct. The revalued amount becomes the cost going forward. That's what you consider when you're now revaluing. And then any revaluation gain, you post it to other comprehensive income. And if there is a revaluation loss, it goes to profit or loss. Each component part of the head office is revalued separately. No, a building is revalued as a whole. You get it? You can't be valuing property and revaluing. When you are saying component parts, for example, you build the property on land. You build a building on land. Then you can't say, I'm valuing the land separately. I'm now valuing the building which is on that land separately. Can you imagine? You are revaluing your house, and here's how you are doing it. you say the house is built on a land, you value the land separately, and then you value the house separately. That's not it. They are revalued together as a composite. You get that? And then the residual amount, yes, that one again is correct. So 3 is false, C is false there. Assuming that Scully represents a cash generating unit, what is the carrying amount of brand at 31 December 20x8 following the impairment review? They are now saying what is the carrying amount of the brand following the impairment review. Now you know when we undertake an impairment review, here's how we proceed. Remember, we say carrying amount. Actually, we say asset. Then we say carrying amount. Then we say impairment loss. And then we say recoverable amount. So whenever there's an impairment review, you first eliminate goodwill. You know that? You attribute loss to goodwill first for a cash generating unit. So you say goodwill. So here goodwill becomes it has a carrying amount of 1,4, and then impairment loss 1,4. You eliminate that. Recoverable amount equals this minus impairment loss. Then you allocate. Then what you do then is you check here. You check here whether there is, because there is an element here of saying current assets are at recoverable amount, meaning these ones there's no need to impair them. But remember, total impairment loss, your total impairment loss is 2,2. That's your total impairment loss, 2,2. So current assets, these they are already stated at their recoverable amount of 2,4, and there's no need for you to impair them. 2,40 here. So their recoverable amount is 2,4. But the remaining assets now, like brand name and PPE, you come here and say brand name. The other one is property, plant and equipment, PPE. So what will happen is, for brand name, you take their carrying amounts. Their carrying amounts here, it's 6, 2 and 6. So you put 2 here. You put 6 here. That's the carrying amount. And then what it means, the total carrying amount for these is 8. So if you want to see impairment loss which is allocated to brand name, you check what is the balance of impairment loss, the balance of loss which we are yet to allocate. The balance of the loss which we are yet to allocate is, you say 2,2 minus 1,4. 2,2 minus 1,4, you get 0,8. So loss which we are yet to allocate is 0,8. Then this 0,8 is allocated to the remaining assets in proportion to their carrying amount. So the brand will take 2/8 times 0,8. That's what the brand name will take. So the brand name will take equals 2/8 times 0,8. So that's what the brand name will take. 2/8, or sorry, 2/8 times 0,8. So it will take 0,2, and then its carrying amount will be 1,8. So the examiner is asking the carrying amount of the brand name following impairment review. So the answer there that we put to this question is 0,8. Carrying amount of the brand name. Remember, after following impairment review, carrying amount is as good as the recoverable amount. So carrying amount is as good as recoverable amount. So it will be 1,8. So there you go. And then which of the following, if any, which of the following, if any, which, if any, of the following statements regarding impairment reviews is or are correct? Talk to your say on this one. Right.
I think both 1 and 2.
Both 1 and 2. Let me read them. At the end of each, now the same, at the end of each reporting period, an entity should assess if there is any indication of impairment that assets have been impaired. Yes. Annual impairment reviews are required on all intangible assets with indefinite lives. Yes. Both are correct, 1 and 2. Right. The following, so, imagine you would already have your 10 marks. This is now another. The following is an extract from Dyer's company's trial balance as at 31 December 2008. Inventory, trade receivables, loan notes, 5% loan notes. The inventory count was completed on 31 December 2008, but two issues have been noted. First, products with a sales value of 0.6 have been incorrectly excluded from the inventory count. Remember, 0.6 is the sales value, meaning it's not cost. When you are including in the inventory, you remember to take out margin or profit content from that. Because inventory, we use cost, not sales value. So they are saying they've been incorrectly excluded from the count. Second, items costing 0.2 million, which had been included. So there is 0.6 excluded and 0.2 included, which have been included were damaged and could only be sold for 50% of their selling price. So they are no longer going to be sold for their normal selling price. Dyers makes a markup of 50% on both of these items. Dyers entered into a factoring agreement with Finade on 31 December 2008. In accordance with the agreement, Dyers sold trade receivables with a carrying amount of 6.2 to Finade for 6 million. Under the terms of the factoring agreement, after 6 months, Finade would return unpaid receivables to Dyers for collection. Finade would also charge Dyers a fee for an uncollected balance at the end of each month. So this is like factoring with recourse. It's like factoring with recourse because you get the money on the security of your receivables. So the receivables had a carrying amount of 6 million. And what you do is you get the money for the receivables at a carrying amount of 6.2 million, and then you get 6 million. Factoring, it means selling your debts, and you get 6 million. But the agreement is of such nature that after 6 months, that company which you factored your receivables, which is Finade, will return any unpaid receivables to Dyers for collection. So in other words, Dyers still retains the risk of bad debts. Dyers still, if its receivables fail to pay, Dyers still bears the risk. You get it? So it's like with recourse. And then Finade will also charge a fee of 5% on any uncollected balance at the end of each month. So this is like a financing. It's a financing arrangement there. Then 5% loan notes were issued for 9 million on 1 July 2006. Dyers incurred issue costs of 5 million with this, which has been expensed within the finance costs. The loan note interest is payable at 30 June each year, meaning in arrears, and Loan note is repayable at a premium, giving an effective interest of 8%. Remember what I told you. If you have got a loan note, it's a financial liability at amortized cost, and you amortize using effective interest, meaning what you include as finance cost, it's not the coupon. It's not the coupon, but here they are saying it's not the coupon, and here they are saying issue costs were also included in finance costs. I told you that issue costs are deducted from the fair value. They are not included in as finance costs. So let us have questions now. In accordance with IS 32 financial instruments presentation, which of the items in the trial balance would be classified as financial instruments? Talk to your say on that one. Which of the items in the trial balance should be classified as financial instruments? That one is easy question. All right. So what do you get here? C. I agree with you. C is a financial instrument because receivables are financial instruments and loan notes are financial instruments. Inventory is not. Inventory is not a financial instrument. What is the correct amount of carrying? What is the correct carrying amount of inventory to be recognized in DIAS financial statements as of 31 December 2008? This one, let me do it with you and see. So inventory, we have got concerning inventory, we have got reported balance, reported balance. Now, reported balance of inventory, we are told here that it's 8.6 million. So you put 8.6 here. Then we are told that there was inventory which was omitted, but it has a sales value of 0.6. So you say omitted. So omitted is sales value. You say sales value. It's 0.6 less margin to get cost. Less margin. Now, what is the margin? We are told that markup is 50%. So it means margin is 50 over 150. The reason is if you are given sales value, you don't work with markup, you work with margin. So margin becomes 50 over 150. Remember, if markup is 50 over 100, margin is 50 over 150. So it's like equals 0.6 minus, open bracket, 50 over 150 times 0.6, close bracket. So this was omitted inventory. And then there is another inventory here which is damaged. Now, concerning damaged inventory, it's already in there. It's the damaged inventory already in there. It's already included in 8.6. So what we do with this is, what is the cost of the damaged inventory? Cost of it is 0.2. 0.2. That's the cost of the damaged inventory here. They are telling us that it is a cost of 0.2. But it is now expected to sell at 50% of its normal selling price. So you then say, we call that net realizable value of it, NRV, meaning the amount that you can recover now. Remember, its normal selling price is normal selling price, remember it's 0.2 plus markup of 50%. it's 0.2 plus 50%, which is equals to 0.3. 0.2 plus 50% of 0.2, you get 0.3. Then it's now selling at 50% of its normal selling price. We are told that it's now selling at 50% of its normal selling price. So it's now selling at 50% of 0.3, meaning you can only now sell it at 0.15. So this is the net realizable value. And according to inventory valuation basis, inventory is valued at the lower of cost and net realizable value. So here it is included at 2. Instead, we should include it at 1.5. So there is now write down to NRV. We now have to write it down to NRV, which is as good as saying 0.2 minus 0.15. So this is what you then have to do. This minus this. You have to write it down by subtracting 0.15. And then you add this up, you get the correct carrying amount of inventory, which is 8.95. That's the correct carrying amount of inventory here. What is the correct carrying amount of inventory? It's 8.95. So the answer is A. Right? Then another question is, in an attempt to improve profit, to improve reported profit, the directors of DIAS want to change the valuation method of inventory from FIFO to an average cost. Now, if you are changing from FIFO to an average cost, this one is a change of accounting policy. It's not change of accounting estimate. And I told you that if you change an accounting policy, or because this is a basis, meaning it's a part of policy. If you change accounting policy, you adjust for it retrospectively. You not prospectively. But if you change accounting estimate, you adjust for it prospectively. Now, you may say, can you give us a distinction between change in accounting policy and change in accounting estimate? If you are changing accounting policy, you are changing the basis that you use, or you are changing how an item is classified in the report. For example, if you are now charging depreciation to cost of sales, that's an accounting policy, because you are affecting classification. So if you are now adjusting financial statement, you adjust it retrospectively, meaning from the earliest date possible. You go back and adjust account. But what is a change in accounting estimate? A change in accounting estimate is, it doesn't really affect classification of an item, but it affects the amount reported. For example, if you change depreciation from straight line to reducing balance, we say it's a change in accounting estimate. Or if you repay a government grant, it's a change in accounting estimate. And now, how do you account for that? If you change an accounting estimate, you don't affect prior period financial statements. It just affects financial statements for this year going forward. So this one now is a change of a basis of inventory valuation. So it's a change of an accounting policy. Basis are accounting policies, remember. So this will represent a change in accounting estimate? No. So one is out. And then financial statements will be adjusted prospectively? No. It's a change in accounting policy, and financial statements will be adjusted retrospectively. So neither 1 and 2 is correct. So the answer is D here. Right? Which of the following statements regarding factoring is not true? You know, factoring, you need to understand the factoring arrangement here. The factoring arrangement is of such nature that, you know, let me come to the question. The receivables that you get, you factored receivables of 6.2 million, but you got cash of 6 million. What does that tell you about 6.2? You have debtors for 6.2 million and you need cash. On that 6.2, I give you cash of 6. It means 6.2 is an expense. Simple as that. The 6.2 is an expense because you have already written it off. You know the double entry for this factoring arrangement. If I have got cash of 6 and you have receivables of 6.2, it means, effectively speaking, you are saying your receivables have paid you. That's what it means there. But they have paid you 6 because you got money of 6 instead of 6.2. So what then happens to the 0.2? You then have to write it off. You then have to write it off to profit or loss. This issue of 5% of uncollected debts, well, we are yet to be told which ones were uncollected. So we can't work with figures, which is just saying 5% of uncollected balances. We are not even told what were these balances which were uncollected. So we work with 6 and 6.2 and 0.2. I mean, and 6. So how then would you deal with such receivables in your books? 6 million should be recorded. 6 million. Well, the statement, oh, sorry. The question is saying not true. Not true, sorry. So let me come back again. Let me come back again and I had taken it to be true. So notice here. Notice here. You have receivables of 6 million. 6.2 million. And you come to me and say, I want to do debt factoring on these receivables. Then I give you 6 million. Let me do it step by step. Your receivables are 6.2 million. And I give you 6 million. So you say receivables. This is how you account for it. You say receivables, 6 million, 6.2 million. And then what then do we do? We then say, you then say here, because this is factoring with recourse. It means if the amount, if your debtors do not pay, FinAid will return them. By saying FinAid will return them, in other words, FinAid will need its money back. So it's factoring with recourse. Now, if you get money from FinAid and it will need its money back if your debtors fail to pay, it means the money that you got is like a loan and you used your debtors as collateral. Are we together? The money that you got is like a loan and you used your debtors as collateral. That's what it means. So you then have to say bank 6. You then have to say bank. Let me say. You then have to say debit bank with 6 million, and then credit FinAid. It's a payable FinAid. These are liabilities. You credit with 6. But remember, so because it's a factoring with recourse, it means your receivables will still be recognized in your books. There is no need for you to remove your receivables in your books because factoring is with recourse. Remember, I said I had interpreted it like with non-recourse when I was saying it's as good as you have been paid. Now, this is statement which I have underlined, which says FinAid will return the money. It means it's factoring with recourse. So if it's factoring with recourse, meaning you have given money but you used your debtors as collateral, what it simply means is you still have to, oh sorry, yes Gunyai, rekani kokufonera kaGunyai mamanje. Oh, alo unogona kunyora message ndozoyatenda tu ndokubata. Okay, what I was saying is you were given 6 million but you used your debtors as collateral. It's as good as you go to the bank loan and get a loan and use your building as collateral. Does it mean your building is no longer in your books? Your building still remains in your books as PPE, but the loan, you credit the loan account. So this is the same arrangement. Now you may say, why are you saying it's a loan? It's a loan because FINED will retain any unpaid receivables. Meaning if your debtors fail to pay, FINED will require its money back. That's what it means. So in what way is that different from a loan? It's a loan. So you still need to continue to account for your receivables in your books at 6,2. So there's no change to the 0,2 there because it's with the recourse. So if I'm to read the answers again, he's saying 6 million received should be recorded in liabilities of debtors. Yes. 0,2 should be expensed to profit or loss. No. This time, why am I saying no? It's because it's factoring with recourse. If it was with non-recourse, meaning if your debtors fail to pay, you don't refund the money. So clearly you have to de-recognize your debtors because it's as good as they are no longer yours. Under the circumstances, this answer was going to be correct. But because it's with recourse, this answer becomes false. So the question says which one is not true? So this one is not true. B is not true there. B was going to be true if it was non-recourse factoring. But because it's recourse factoring, B is not true. In respect of 5% loan notes, how much should be expensed within Dyer's company statement of profit or loss for the year? In respect of 5% loan notes, how much should be expensed within Dyer's statement of profit or loss for the year? So it's a matter of this one is what you do is it's a financial liability at amortized cost. Remember, loan notes, they are financial liability at amortized cost. Remember what I said? I said you say yeah, don't, then you say opening balance, and then you say effective interest. Effective interest, we are told that it's at 8%. And then what else do you do? Effective interest at 8%, then you say coupon. Coupon, you subtract coupon, and then you have closing balance. And I said closing balance is the amortized cost. That the closing balance is the amount which goes to statement of now 31 December 20x8. 31 December 20x8. So it's like the year is x8. Now it's important to read your question carefully so that you don't miss a point. I always like to do it that way. Now loan notes are 9 million, but in the last paragraph we are told that they were issued on 1 July, meaning they have been there just for 6 months. So they incur issue costs of 0.5, and I said issue costs you need to, they were issued for 9 million and issue cost was 0.5. So issue cost, you subtract issue cost from the fair value at initial measurement. So it's equals to 9 minus 0.5. Issue costs are deducted. Then effective interest. Remember, it's 8%, but for the first year, it was just 6 months. So you say equals 8% times opening balance, like this, times 6/12. Always know that. 0.34. And the coupon is levied on the par value, meaning coupon of 5% is charged on 9 million. But already you can get your answer like this, because the question says how much was finance cost. So the finance cost was 0.34. Though you can say, you can complete your line and say coupon equals 5%. It is levied on 9 million times 9. Coupon is not calculated on opening balance, but on the fair value or par value that we issued the loans, and then times 6/12 again. So you can now have your amortized cost as this plus this minus coupon. Remember, coupon is a periodic cash flow, so that is the amortized cost. So the answer they need there is 0.34, which is what you charge to profit or loss is the effective interest. So the answer is D. Are you not seeing there's a temptation for you to just say, 8%, 8% to say 0.08. There's temptation to say 0.08 times 8.5, and you get the answer as 0.68. That answer is there on A. It's so tempting. The reason why it's so tempting is because they know, the examiners know, that perhaps you didn't figure out that this was issued on 1 July. So it's important to take note of the dates there, so that you pass this, you don't fail this. All right, next. Jeffers prepares financial statements for the year ended 31 December 2008. The financial statements are expected to be authorized on 15 March. So year-end date is 31 December 2008, and authorization date is 15 March. So what happens is, if there is any event between 31 December and 15 March, it is called an event after the reporting date. That is called an event after the reporting date. And these events are either adjusting events or non-adjusting events. In what way is it an adjusting event? It's an adjusting event if it requires you to go back to 31 December 2008 and adjust the accounts. It's a non-adjusting event if it does not require you to go back to the accounts and adjust them, but it simply requires you to disclose it. Non-adjusting events, they merely require disclosure. They don't require you to go back to the financial statements and adjust. That's another thing. Another thing is, what then are non-adjusting events and adjusting events? Adjusting events are events which provide further evidence of what was obtaining at reporting date. For example, you know that at each reporting date, we provide for bad debts, allowance for receivables, or provision for bad debts. Meaning, we are thinking that some of our customers may not pay. No wonder why we are having provision for bad debts. Now, if a customer then is declared insolvent, say in January, we now have more evidence, because at 31 we just have an estimate, but now a customer was declared insolvent. So we need to adjust, because we now have evidence that this is bad debt. We had provided for it, but now we have evidence. No wonder why we call it adjusting event. Or another issue is, you know that inventory is sold, is recorded at the lower of cost and net realizable value. Meaning you consider cost of inventory and NRV, you take the lower, that is becomes the amount of inventory to be recognized. So if in between these two dates, you have a situation where between 31 December and 15 March, you have a situation where inventory had a cost of 20,000, but it was sold for 16,000. It means you now have more information that the inventory you had at 20,000 on 31 December was overvalued, because you now have better information on its net realizable value. So you have to go back to the accounts and adjust. But now, so what are non-adjusting events? Non-adjusting events are events which, we had no idea whatsoever at 31 December that they were going to occur. Unlike adjusting like bad debts, we had some idea. But here we had no idea. Issues like fire. Suppose there's fire at the factory. You can't say because there was fire, so fire destroys all the warehouse with inventory. So you can't go back and adjust because you didn't anticipate fire. Suppose there is acquisition of a business in between. You can't say you acquire business in January and then you go back to 31 December accounts and begin to consolidate. Does that make sense? A business is acquired in January. Can you say, let us go back to 31 December accounts and begin to consolidate? Yet it was not a subsidiary then. You had no evidence of that at 31 December. So you can't go back and consolidate. Suppose government changes tax or legislation. There's legislation or tax rate which is changed between. You can't say tax was changed in February, so I should go back and adjust accounts for 31 December 20x8 with the tax which was changed in February. All these are non-adjusting events. So just letting you know. So health and safety fine. A health and safety investigation of an incident which occurred in 20x8. Notice, an incident occurred in 20x8 but concluded in January, resulting in 1.5 million fine by Jeffers. A provision of 1 million has been recognized in Jeffers' financial statements for the year. So, Jeffers was thinking that somehow it was going to pay a fine. So it had made a provision of 1 million. And now the court case or the investigation was concluded in January, meaning it was concluded between year-end date and authorization date. So Jeffers had made a provision of 1 million, and now court investigation said it was 1.5. So are you noticing this is now providing more evidence to what we have? It is providing us with more evidence to what we had. So it's an adjusting event. Because we had an idea that we are going to pay fine, but we were not just sure. So we had to go back and adjust. Customer ceased the trading, so that's bankruptcy of a customer. I told you that this one is an adjusting event because at each reporting date we make provision for bad debts. So if a customer then is declared bankrupt, clearly it's now a bad debt. So it's now more evidence of bad debt. So that one we again adjust. Acquisition of a competitor. This one you can't go back to the financial statements and to the December financial statements and consolidate if you acquire on 10 January. Remember, you consolidate from the date of acquisition, from the date you obtain control. Because once you at 31 December, you had no control whatsoever, so you can't go back there and even though you are told that negotiations commenced in May, but you didn't have control whatsoever. So you can't go and adjust accounts where you did not have control. Right. In addition to this, there is an outstanding court case. There is an outstanding court case at 31 December 2008 relating to faulty goods supplied by Jeffers. Legal advice states that there's a small chance that Jeffers would pay 6 million. We have to pay 6 million. But the most likely outcome is believed that it will pay 5 million. Either way, Jeffers will have to pay legal fees of 0.2 million. All payments are expected to be made on 31 December 2009, meaning within 12 months. Jeffers' cost of capital is 10%, meaning discounting factor 0.909. Okay. Jeffers' company believes the fault lies with the supplier and is pursuing a counterclaim. Legal advice states that it is possible but not likely, and that action will not succeed. Now, Jeffers is being sued at court, meaning outstanding court case, that it sold faulty goods to a customer. So the customer is saying, legal advice is saying Jeffers can actually pay 5 million plus legal fees of 2 million. They are saying there's a small chance that it will pay 6 million. So 6 million, we cross it out because there's a small chance for it. It's not relevant. So we talk about most likely outcome. So the most likely outcome are these. But remember, 5 million is to be paid after a year. So it has to be discounted to today. No wonder why you are given a discounting factor to find its present value. Now, Jeffers is also saying, look, this court case is not my problem. The goods that I supplied to the customer, which were faulty, I was given those goods by my supplier. So if a customer is suing me, I am also going to sue my supplier. This is now called a counterclaim. Jeffers is being sued by a customer, which is a liability. And Jeffers is now suing its supplier, which is an asset. And this asset is called contingent asset. It's called contingent asset in what way? Because by counterclaim, it is Jeffers which is receiving money. If Jeffers is suing its supplier, it's now the one which is going to receive. So it means it's an asset. And you know that all contingent assets are not recognized in books. All contingent assets, meaning assets which are conditional upon something. Like this one is an asset which is conditional upon you winning the court case. Such assets are not recognized in books at all. You get that? So, so let us answer. Which, if any, of the following regarding IAS events after the reporting period, meaning IAS 10, is or are correct? Talk to me. Talk to me. Remember, we have got time constraints. We need to be fast. Oh.
1 is wrong, but 2 is okay.
Yeah, 1 is saying events after the reporting period are deemed to be all events from the date financial statements are authorized. Oh, no. 1 is wrong. You are correct. Because these are events between year and date and authorization date. Year and date, which is 31 December, and authorization date. 2 is saying non-adjusting events do not need to be reflected in any part. No. This is again wrong. I said non-adjusting events, they require disclosure in the notes. Remember, notes are also part of financial statements. When you prepare financial statements, you prepare notes to the financial statements, and they are part of financial statements. So if there is a non-adjusting event, you don't need to adjust the figures, fine. But you need to disclose it in the notes, as I have said it. So this statement is saying it is not need to be reflected in any part. No, in that case it's wrong, because we said it must be disclosed in the notes to the financial statement. Which of the following 3 events occurred in January would be classified as adjusting events. Okay, so this part we have discussed it. We said health and surfeit fine adjusting event, customer ceasing trading adjusting event, acquisition of a competitor is non-adjusting. So 1 and 2 only. 1 and 2 only there. Acquisition of a competitor is a non-adjusting event. Right? Then another point is, what amount should be recorded as a provision in respect of outstanding court case as a 31 December 2008? In respect of outstanding court case, what amount should be recorded as a provision? So if you want to calculate the amount to be recorded as a provision there, I remember I have crossed out the unnecessary parts. The unnecessary parts, I've crossed them out. So it's a matter of focusing on the parts which matter. You just discount 5 million by 0, to say 5 million times 0.909, you get 4,5. Then they have to pay legal fees of 2 million. They are saying all these payments are to be made on 31 December. Oh, so it will be 5,2 times for 0.909, which is 4,7. So 5 plus 0,2, but we are going to pay them a year later. So discount by multiplying by 0,9, and you get you get 4,7. So the answer there is C. At 31 December, which of the following statements represents the correct accounting treatment of a counterclaim? I told you that counterclaim is a contingent asset, and a contingent asset we don't even do anything about it. A contingent asset, we don't even do anything about it. I told you. Assets are not recognized in advance. We don't recognize assets in advance to say, oh, there's a chance that we will win a court case, so let us recognize a receivable. No. No. So the answer to question number 29, as I have said, it's A. Nothing is recognized or disclosed in the financial statements because that one is a contingent asset. In February 2009, a fire broke out in Jeffers property. Remember, year-end date is 31/2008 and authorization date is 15 March. So February 2009, it is still an event after the reporting date. Jeffers company has no insurance, and now management of the company believes that it is unable to continue trading. Now, if as a company, if there's a fire which broke out and now you believe that you can't trade, now the whole thing changes. If you believe that you can't continue operating as a going concern, your accounts, your financial statements should not be prepared as if you are going to operate as a going concern. They should be prepared on a liquidation basis, because it's like you are going to close the business. So now your financial statements should now be, whenever there's no more room for going concern. I'm sure you did this when you are doing auditing, that if going concern assessment is now questionable, your financial statements should now be prepared as if you are going to close the business, meaning you no longer prepare financial statements on a going concern basis. So how should this be reflected in the financial statements? You are no longer going to prepare those financial statements on a going concern basis. So no adjustment should be made. No. But however, this event must be disclosed in the notes. This answer was going to be correct. Notice, fire is a non-adjusting event. This answer was going to be correct if this fire didn't result in threatening the going concern position. But if fire if there is a fire and the company is still able to operate as a going concern, you don't adjust financial statements. All you do is you disclose in the notes. But if there is fire and now the company is unable to continue trading, you now need to prepare accounts on a liquidation basis because you are now closing the business. So the financial statements can no longer be prepared on a going concern basis. So the answer is B. The answer is B. This is the answer here. Right? Notice already you have your 30 marks. 30 marks. Right? Consolidated statements, the consolidated statements of profit or loss of Pelo Group for the years ended 31 December as shown below. So this is for Pelo Group, 20x8 and 20x9. Notes. On 31 December 20x9, Pelo Group disposed 80% of its holding in Samba, meaning there was a subsidiary called Samba, a software development company, for 300. So disposal proceeds were 300 million. Samba company's results have been fully consolidated in the statement of financial position above. So remember, we disposed it at the year end. So it was a subsidiary throughout. No wonder why it was already included there. Samba does not represent a discontinued operation. Fine. The proceeds from the disposal of Samba have been credited to a suspense account and no gain or loss has been recorded. So they are yet to calculate gain or loss on disposal of this particular subsidiary. Pelo originally acquired shares in Samba for 210, so this was the cost of the investment. At this date, goodwill was calculated as 70. Remember, if you dispose a subsidiary, you also dispose goodwill. Goodwill has not been impaired since acquisition, and external advisors estimate that goodwill arising in Samba has a value of 110 at 31 December. Remember, we told you that goodwill cannot be revalued. Remember, goodwill at acquisition was 70, and now they are saying it is 110. Goodwill cannot be revalued. Why? Because an attempt to revalue goodwill amounts to recognizing an internally generated goodwill, and internally generated goodwill must not be recognized. We only purchase the goodwill, so goodwill cannot be revalued upwards. Rather, you test it for impairment. Also, goodwill is not depreciated, you know that. On 31 December 2009, Samba had net assets with a carrying amount of 260, meaning this subsidiary we disposed. On the date of disposal, its net assets had a carrying amount of 260. In addition to this, Samba had a brand name which was valued at 50 at acquisition. So it was valued at 50 at acquisition. This is not reflected in Samba's individual financial statements. What they are simply telling you here is that this 50 is not reflected in assets of Samba, meaning it's not reflected in 260. And the value is assessed to be the same at 31 December 2009. Perfect. So there you go. Samba company is the only subsidiary in which Pelo Group owned less than 100%. Pelo Group uses fair value method to value NCI. So it's called the full goodwill method. What it means is NCI is a share of goodwill. At 31 December, the non-controlling interest, meaning at the date of disposal, the non-controlling interest in Samba was deemed to be 66 million. That was the fair value. Until December 2008, Pelo rented a space in its property to a third party. This arrangement ended on 1 January 2009, meaning Pelo was renting property to a third party, meaning someone was renting up to 1 January 2009, meaning up to beginning of this year. Or this arrangement ended, yes, meaning it ended up at the beginning of this year. That's 1 January 2009. Samba company's administrative department. So we were renting it to a third party, and then we disposed the subsidiary, Samba. And Samba, after we disposed it, it began to rent the property. Now, meaning our former subsidiary is now the tenant. Samba company's administrative department moved into Pelo's property. Pelo charged the Samba company a reduced rent. Samba company's properties were sold in April at a profit of 2 million, which is included in administrative expense. So the reason why this subsidiary is renting from us is because its properties were sold. Remember, it was our subsidiary, we sold it, and after we sold it, it also sold its properties. So it's no longer have properties. No wonder why it's now renting to us, the former parent. On 31 December 2009, the employment of two founding directors of Samba was transferred to Pelo from the date of disposal, meaning when we disposed the Samba, its founding members, they remained our workers. We employed them as Pelo. Now Pelo will go into direct competition with Samba. They are saying from the date of disposal, Pelo will go into direct competition with Samba. So as part of this move, the directors did not take their annual bonus of 1 million each from Samba. Instead, they received a similar joining fee from Pelo, which was paid to them on 31 December. These individuals have excellent relationships with the largest customers of Samba and are central to Pelo's future plans. Samba, so this is like basic stuff. We disposed the subsidiary and we took its directors because we know this after a subsidiary is disposed, it is going to be our competitor. So what we then did, we took its subsidiaries because we took its directors because we know that these directors, they have connections with the customers of Samba, who is going to be our competitor now going forward. Now, Samba's revenue remained constant at 2.6 million in both 20x8 and 20x9, and Samba's company has high levels of debt. Key ratios from Samba company's financial statements are shown below. So these are the key ratios. Gross operating profit margin. This is for Samba only. Now, calculate gain or loss on disposal of Samba, which will be reported in the separate financial statements of Pelo and in the consolidated group. So I'm sure you played this in the last week's video that I sent to you. That how you calculate gain or loss on disposal or loss on disposal in separate financial statements. There's gain or loss on disposal in separate financial statements, and then there's gain or loss on disposal in consolidated. Now, when you're calculating gain or loss on disposal in separate financial statements, it's a matter of saying cost of investment, you simply say disposal proceeds or proceeds. How much did you dispose your investment in Samba? So it's a matter of saying we disposed the Samba for 3 million. It was sold for 300 million. Here you go. 300 million. So disposal proceeds, you say 300, and then you say less carrying value, less carrying amount of investment disposed. Carrying amount of investment disposed. The amount disposed. The amount that you disposed this particular thing, it was 300. And what was its carrying amount? So carrying amount, you get it when they say Pelo originally acquired shares in Samba for 210. So 210 was the cost. So you say 210. 210. This is gain in separate financial statements. Simple as that. Gain in separate financial statements. In Pelo's separate financial statements. Not in consolidated, in separate. 90. 300 minus 210. You get 90. And then you come here and then say gain or loss in consolidated gain or loss on disposal of some. This one that we consolidate now. Consolidated gain or loss on disposal of some. Please, if you have not played last week's video, please play them. No wonder why I give you those videos, so that when we revise now, it makes sense. I know I would have covered that in the video. Now, gain or loss, consolidated gain or loss on disposal of some. So this one is a matter of say you again say disposal proceeds. Disposal proceeds, you put 3 million here, 300 million, and then you say less net assets at date of disposal, net assets at disposal. Now notice how you calculate it. You actually say net assets at disposal. You calculate it like this. You say carrying amount of net assets, carrying amount of net assets. This is now at disposal, not at acquisition. So at disposal, carrying amount of net assets is, they are saying it's 260, but 260 excluded the brand name, which was 50. So you are saying 260, you open brackets here and say carrying amount of net assets, you say 260 plus 50. Because 50 we are told it was not included. So this becomes 310. And then you say less NCI in net assets, less NCI in net assets. Now, these net assets, they include NCI, which we are told that it was 66. So you say minus 66 here. And then what else do? You then say, after doing this, you then say goodwill disposed, because they are saying goodwill has not been impaired. So goodwill disposed, because you disposed the subsidiary, you then have to take out goodwill. Goodwill disposed. It was 70. So what you then do is you want to find whether there is gain or loss in consolidated. So you say equals sum equals minus sum of this 14, and you notice that there was, in this case, there was no gain on disposal. There was actually loss on disposal, group loss on disposal, group loss on disposal. There was a group loss on disposal, which was 14 million. No wonder why the examiner is telling you that here no gain or loss has been recorded. No gain or loss has been recorded in the financial statements above. So what it means is, no wonder why they are saying, can you calculate it? No wonder why the question is saying, calculate gain or loss which will be recorded, because it's yet to be recorded. Are you getting it? They are now saying calculate ratios equivalent to those provided in the note for Pelo Group for the years ended 31 December 2008 and 20x9. No adjustments are required for the gain or loss. No adjustment. So they're saying don't calculate using gain or loss that you have calculated in A. So you want to calculate gross profit margin, operating profit margin, and interest cover for payroll group. So it's a matter of coming here and saying payroll group, equivalent ratios for payroll group, equivalent ratios for payroll group. And another thing is, you may say, do I use word process or what? No. In your exam, if the examiner wants you to use Excel, the examiner will put Excel. If the examiner wants you to use Word, the examiner will put Word. And notice it's possible even to answer, to calculate ratios with Word on Word. All you simply do is you make sure that it's just 3 marks, guys. 3 marks. So don't struggle much for 3 marks. 20x9 and then 20x8. But can you imagine, already here or at the first part you have 5 plus 3, you already have 8. So for you to pass this question, you are only left with 2 marks to pass this question. Can you imagine? So the ratios are gross profit margin, and don't bother yourself to say we'll give you marks on showing us how you have calculated the gross profit margin. Surely at your level, gross profit, to just saying gross profit over sales, operating profit margin, operating profit margin, and then interest cover like this. Now, we are working for payroll. So for payroll group, we are just using the information which is at the top here. So gross profit margin is it's 97,860 over 97,860. Let me do step by step. Equals 97,860 over 213,480. 213,480. So there you go. On 20x8, it's 97,310 over 216,820 equals 97,310 over 216,820. So this is your gross profit margin for payroll group. You put it as a percentage. Then then operating profit margin. Remember, operating profit, you just say profit from operations and you divide that by sales. So it will be like, now you can call it profit from operations. Some call it EBIT. So it's a matter of 25,500 over 213,480 equals 25,500 over 213,480. Then here it's 29,170 over 216,820. 29,170 over 216,820. That's your operating profit margins, or it's a matter of calculating profit from operations. And you again give your answers as percentages. Then interest cover. Interest cover, it's simply profit from operations over finance cost. That's interest cover, profit from operations over finance cost. So it's like 25,500 over 17,800 equals 25,500 over 17,800. So you can still have these, but you can put formula. Let me show you how you can put it, just in case you want to show the formula. perhaps for the examiner to tell that, oh, well, you took wrong figures, but you knew the formula. Now, 29,170 over 16,200 equals 29,170 over 16,200. So interest cover here, so 1,8. Now, I said you can still find it convenient for you to show yourself formula. You can just open brackets here and say gross profit over sales. Don't put figures times 100%. Already the examiner knows the figures that we have taken. Here, operating profit over sales times 100%. This is enough for the examiner. The examiner is already in the loop. You already knows what you are doing. Here it's operating profit over finance cost. Operating profit over finance cost. You are done. But you write in full, you don't say OP. So are you getting it? So this is how you would put it. If it was a word processor, if there was a word document, you can see that if you present your answers like this, it's a table. Meaning it's a matter of just putting a table to say ratio, formula, 20x8, 20x9. You say ratio, formula, 20x8, 20x9, so that your presentation will be nice. I don't want presentation where you are writing one after the other. Ratios, normally calculate ratios in a tabular presentation for you to be neat. Don't calculate ratio one after the other, like 20x9, then you work 20x8 below, 20x9, then you work 20x8 below. No. If the examiner is given you ratios presented like this, why can't you just present also like that? It's nice that way. But of course, in your answer, it's recommended to show the formula that you have used. Make sure it's recommended that you show us the formula. Comment on the performance and interest cover of Pelo Group for the year ended. Now, you know what? When you are commenting here, the examiner is already telling you that your comments should focus on overall performance of Pelo Group, meaning overall, and then how, once accounted for, disposal of Samba will impact on your analysis, and implications of the disposal of Samba on future results of Pelo Group. Now, as you can see here, that performance. Notice performance of Samba as a subsidiary against performance. Again, if I can put Samba here, when you are commenting now, it's required that when you are commenting on performance, you know, when you are commenting on performance, these are the ratios you use. You focus on these ratios. You focus on gross profit margin, GP margin, operating profit margin, even net profit margin, even I've said net profit margin. You also focus on return on capital employed, ROS. These are not on this question, but I'm just telling you, net asset turnover or asset turnover, meaning how you are using assets. You also look at revenue growth. All these are called performance measures. You may be asked by the examiner to just comment on performance. If the examiner asks you to comment on performance, this is what you look at. This is exactly what you look at. If the examiner may also ask you to comment on position. Comment on position. You focus on these ratios on position. Liquidity. Are you not seeing the difference? There's liquidity You focus on gearing. Focus on liquidity gearing. You can also focus on the the issues to do with a lot of other things like activity ratios, things to do with receivables, collection periods, payment, payables, payment period, etc. All those are position. Actually, position ratios, you are talking of balance sheet or statement of financial position. Performance ratios, we are talking of statements of profit or loss. Now, here are the guidelines when you are commenting on ratios. Guidelines whenever you are commenting. Guidelines when commenting on performance. Now, position may even include interest cover. Interest cover because it's still on stuff. Remember, interest cover has connotations of gearing as well. Now, when you are commenting on ratios, these are guidelines. When you are commenting on ratios, right? Guideline number 1, telling the examiner that a ratio is just increased. Telling an examiner that a ratio is just increased or decreased doesn't carry more marks, doesn't carry meaningful marks. Though you may get 2 marks or so, but doesn't carry any meaningful marks. Can you imagine? You can't say you are commenting when you are just telling me that gross profit margin increased from 45% to 46%. Is that a comment, or you are telling me the figure that I'm seeing? Always ask you that question. Am I commenting, or I'm just telling the examiner the figure that I'm seeing? You can't say liquidity ratio, interest cover decreased from 1,8 to 1,43, and you move on. Is that a comment? You ask yourself. You know, when you are commenting a Maslin, it's a matter of you ask yourself something. You ask yourself this very basic question. If I am telling my CEO or my director or my boss this, if I said anything sensible, if I just tell my boss that net profit margin has fallen from 17% to 15%, is that in any way meaningful? Is that a comment on a ratio, or it's merely telling the figures? So you ask yourself, so you may say, how then do I comment? This is now guideline number 2. It's like, use information in the scenario. Use information in the scenario to communicate the implications. Let me put it in words, in bold. The implications of the calculated ratio. The implications of the calculated ratio. You need to come up with the implications, meaning it's one thing to tell us the ratio, it's another to tell us what does the ratio mean. That's what I'm referring to as implications of the calculated ratio. What then does that? Now, for example, if interest cover is falling, tell the examiner what is the meaning of fall in interest cover. It means the firm is at risk of not generating enough profits to cover interest, or it might. So that's the main thing. Tell the examiner the meaning of the fall or decline in ratio, the meaning of the fall or decline in the ratio. Please try to tell us what then does it mean that the ratio has fallen. Another guideline, number 3, is use information in the scenario to find possible reasons. Use information in the scenario to find possible reasons for the increase or decrease in the ratios. Why, in your opinion, the ratio have decreased or increased in the period under review? Possible reasons. Let me bold it and shade it in red. This is what is important. I don't think you will have problems if you actually know these 3 points. Telling the examiner that a ratio is just increased or decreased is not commenting. So don't just say it like that and think you are commenting. No. What you should do is communicate the meaning. What does it imply that the ratio is increased or decreased? What does it imply that a gearing or liquidity ratio is increased or decreased? Then find possible reasons from the scenario. Now notice, when I say possible reasons, I am saying this possible reasons. When you are commenting on a ratio, use these words. Don't use words as if you know everything. No, I said possible. So use words such as might, may, probably, likely, significantly, improved, worsened. Don't use words. Don't use these words. When you are commenting on a ratio, avoid using these words. We don't want them. I want to talk about this again, please. When you are commenting on ratios, don't use these words. Best, poorly, very good, great, must. Don't use these words. Must have been this must have arisen from. No. The company reported very good performance, best performance. No. Those are not words in commenting. Use words like improved, it has worsened. Probably it might be result of it. There was a significant increase. Don't say there was a very good or best increase. No, there was a significant improvement. There was something like that. Use words which we comment, not words which appear as if they are definitive, as if you were there. We no wonder why we call them possible reasons. On this one, can you just type noted? Say, I just want your feedback on this one. On this, just to illustrate that you are with me on this one. Can you type noted on the chat feature? Because that's so important. Okay, so perfect. So we are actually in agreement. We are together on this one. Now, having said this, allow me then to just say, oh, I downloaded the question only. There was no answer. I'm sure there must have an answer. Right. Having said this, let me try, because of time, because we want to finish, let me try to read the answer, because I've already explained the key. These are the key things that you then need to understand. Let me open it. And from now on, when you are commenting, try to read what you are writing. You would notice that if it doesn't augurs the same way what we are doing it here, oh, sorry, these are the answers. Notice, gain in separate financial statements, we got it correct. Group gain or loss or consolidated gain, it was 14 million. We again got it right. It was a loss. There was a group loss. Was it a loss? Yes, here. It was a loss of 14. So we got that. So already, notice, already here, already you have 5 marks. Remember, you think examinations are difficult, but you don't. Students are not just smart enough to know where to get marks. This is something very easy. 5, and then this is 3 marks. 45, 45,8, 44,9, 11,9, 13,5, 1,43, 1,8. Now, notice the examiner was busy putting figures for you. I said, remember, this is the examiner doing it. But as because once you put it like this, I'm telling you steps which will save you time. Once you put it like this, it's equally the same, because the examiner, by saying I took this figure divided by this multiplied by 100, and a student which said gross profit over sales times 100, in what way are you different? You are actually saying the same thing, but the student who has put it this way is able to save time, because you can't put figures here and then put them here also on when you are punching. Are you not seeing you'll be doing it twice? So you save time, otherwise you will not finish. So it's 5 marks plus 11. Plus 3. Already you have 8. So you can't tell me that on commenting, you can't come up with 2 marks. But what I want now is, for you to understand the tone when we are commenting. And before I read, let me tell you what is happening. Before I read, you are told that group gain or loss on disposal is yet to be included here. And you realized that we made a loss. So if we made a loss, clearly loss on disposal, it affects it comes here under operating expenses. So what it means is your profit from operations will even worsen from what we have here. And are you not seeing that the figures for Pelo as a group, these ones, compared to the figures for the subsidiary we disposed. Notice the subsidiary is reporting margins of 81%, 80%, operating profit margins of 66%, 41%, and for the group it's 46, 45, 12, 13. For the subsidiary we disposed, it's 8, 6, 81, 6. So you can see here we are disposing a performing subsidiary. The subsidiary is outperforming the group. Are you getting it? But notice, when it comes to interest cover now, the group as a whole has interest cover of 1,8 and 1,43, but the subsidiary has interest cover of 1,1 and 1,2. So what it means is the subsidiary has more debt than the group. The subsidiary has more debt. Can you imagine? It has got huge operating profit margins but low interest cover. It tells you that the subsidiary has got plenty of debt. So if we then dispose this subsidiary, it means for the group, we are going to have high interest cover. Are you not seeing that? Let me repeat. What I'm saying is what you'll be doing when you're commenting. Are you not seeing? I am not saying interest cover for Pelo is 1,43, 1,8. For Samba, it's 1,2, 1, I am saying the subsidiary that we disposed has got high gross profit margins and high operating profit margins than the group as a whole. Implying that, remember, I said implications. What are the implications of this? It implies that the subsidiary is performing better than the group and we are disposing it. And then notice, having disposed this subsidiary, consider it has got interest cover which is higher, which is lower than that of the group, implying that this subsidiary has got higher debt. The subsidiary has got he has got higher finance costs or higher debt than the group. So if we dispose this subsidiary in future, we are going to realize lower profit margins. Why lower? Because we are disposing a subsidiary which is generating a lot of profits. So if we dispose that, it would mean that margins for the group may actually be lower. But when it comes to interest cover, the subsidiary we are disposing has got lower interest cover, meaning it's got more debt than. So if we take it out, as a group, we'll be left with increasing interest cover. Also, this subsidiary, if you notice, it is performing this good. Are you not seeing how good it is performing? It is performing this, or it is performing this significant, posting significantly better results. That's how we may say it is posting significantly better results on performance. But notice, we are going to take its directors. So the founding directors of Samba, which is a company performing these results, we are going to take them as Pelo, meaning they were taken over by Pelo. And these founding directors, we are told, they have got excellent relationship with the largest customers of Samba. So Samba is going to be our future competitor. Now that we have taken its directors who have excellent relationship with its customers, chances are these directors will divert these customers from Samba and to Pelo. And if these customers are diverted to Pelo, Pelo's profitability and margins, we may argue that it may result significantly. Are you not seeing how we comment? Now you can now see. I've just given you the summary of the whole thing. Notice it all boils down to another. There's another thing also that this Samba, its profits that we are saying they are huge. Samba also sold 2 million of its property, and it made a gain. It sold its properties and made a gain of 2 million. So because this gain is included among the gains, when they say it is included in administrative expense, they are saying the gain reduced administrative expense, meaning it was treated as income. So the results of Samba, these ones, if we take out that 2 million, we may actually notice. I'm trying now to explain why the results are this. If we take out 2 million, you may notice that we may actually end up with lower profitability margins, because they are telling you that Samba's results has remained at 26 million. These are sales. Sales was 26 million for both years. So what it means, if you are given sales of 26 million and you are given these figures, do you know you can calculate what was gross profit from Samba? What was gross profit from Samba in 20x8 and 20x9? You can also calculate what was operating profit, because it's a matter of multiplying this percentage multiplied by 26 million. This percentage multiplied by 26 million. You can get operating profit from Samba. You can also get what was the finance cost from Samba, because if you now have operating profit, we are saying operating profit over finance cost equals 1,2. So operating profit divided by 1,2, you get finance costs. Operating profit divided by 1,1, you get finance costs. Now, if you now have actual figures for Samba, because you have calculated them, you can now bring them up here and subtract them. You can now subtract actual figures from Samba. It's like revenue. You take out the 26 because the Samba has been disposed. So we want to see how the group is going to perform after it is disposed Samba. So revenue, you can take out 26. You can also take out gross profit. You can take out gross profit for Samba because you are given the figures. If you multiply gross profit for Samba by the ratios by 26 million, you can get the actual figures. And then with those actual figures, you can then tell directors of payroll that assuming that Samba is no longer in your books, as is the case going forward, your gross profit is likely to be of this in this form. However, since you have acquired these directors, it might. So that's how we would be performing. Now, let me now read. I just want to read and I want you to understand. Comment on performance. Revenue for the group has actually declined. Are you not seeing the words that I said? These are the words to use. Have you noticed they have not said revenue was 216, it's now 213? No. No. Because this is not commenting, we are seeing it. You can't tell us the figures we are seeing and say you are commenting. You have to comment by telling us implication of what we are seeing. So you can now realize that the scenario states that Samba's revenue has remained the same for both years. So the decrease appears to be a decline from the remaining companies in the group. So this is guideline number 2. I said you talk of the implication and possible reasons. Possible reasons. So this is exactly what they are saying. Samba's revenue has remained the same because it's information from the scenario. So the decrease appears to, the word appears. They are not saying the decrease is as a result of, they are saying appears. Now appears is the word likely. When they say appears, the word decrease appears, it means they are using either the word decrease might, decrease probably, decrease likely. That's how you put, these are the words. And notice it's in italics, meaning this is what the examiner is marking. The examiner is marking the words in italics at every point. These words which are in italics are what are carrying marks, and you notice those which are italicized are possible reasons. So always look at possible reasons or possible implications. Notice, whilst there has been overall decline in revenue, gross profit margin has improved 45%. Notice they have used the word improved. And notice the figures are actually in brackets, meaning figures don't really matter. You can actually write your sentence and say, whilst there has been overall decline in revenue, no wonder why I said performance looks at revenue growth. RG there, revenue growth. That's what we'll be looking for. So they start with saying, whilst there was an overall decline in revenue, that's revenue growth, gross profit margin has improved. Notice you can end here even without putting the figures because we are seeing them. Samba has a significantly higher gross profit margins. As I was saying that it has got higher. Notice the figure is in brackets, meaning it does not matter. When figures are in brackets, it means you can leave them out. So putting them don't put figures thinking you are commenting. You may leave them out and still proceed and comment because the examiner knows all these figures. You have calculated them already. So Samba has significantly higher gross profit margin in relation to the rest of the group, suggesting, notice, I said suggesting that Samba is performing better than the group. Remember, that was what we were saying. We are disposing a better performing subsidiary. So suggesting that the rest of the group operates at lower gross profit margin than Samba. That's what it means. So always notice what carries marks. So if you have written this thinking you are going to earn marks, you were wasting your time. Notice, if you have written up to here to say gross profit margin has grown, this doesn't give you marks. Because as from my guidelines, I said telling the examiner that a ratio has just increased or decreased doesn't carry meaningful marks. So don't do that thinking you are answering the exam. No, don't do that thinking you are answering the exam, because you may not even you get any marks from that. So what then do you have to do? What you then? So notice what the words in red now. I say what communicate, meaning tell them the implications, meaning tell them the meaning of this decrease or increase, and then possibly come with possible reasons for this. Oh, that's only you need to know, Tafara, Masni. That's only you need to know, and you earn his marks. Can you imagine? You already had how many marks there? 8. Suppose it was time up after you've written these 2 points. Already you have 10. You have passed your question. Already with this only you have, because the examiner, the italicized points are the points which are which are scoring marks, not telling figures what we are seeing. No wonder why it's not even in italics, because it doesn't matter. Right. So notice the operating profit of margin of the group has deteriorated in 20x9, or remember, deterioration and worsen, it's the same word. I was just giving, notice they said he has deteriorated, but notice what they've said. Figures are in brackets, meaning it doesn't matter to put them. We know them already. No wonder why they are in brackets, meaning if a student just say the operating profit has deteriorated and full stop without even putting the figures, because they are not going to carry marks, we are seeing them. So why putting them? So if the examiner puts it in brackets like this, it means they are just an aid, but not necessarily carrying marks. What carries marks is what is the implication of that decline, and what are the possible reasons from the scenario. So this is initially surprising due to the significant increase in operating profit margin of Samba. However, the increase in Samba's operating profit margin may not represent the true increase in performance of Samba due to the following. Are you not seeing possible reasons? And possible reasons are what I've told you. I've told you that Samba sold the property and disposed the property and made a profit of 2 million. And this profit is recorded this profit is accounting also for its increase in operating profit margin. But you know that 2 million is not if you are disposing assets, you can't say it's operating profit, because those are once-off activities. They are not day-to-day operations. Are you not seeing? They are just identifying issues from the scenario as possible reasons. In addition to this, Samba was charged a lower rent by Pelo, which may also have impact in its profit margins, because we are told that Samba is now renting Pelo's properties, but it is paying a lower rent than the market. You get that? So I'm sure you are now agreeing with me. You can now proceed and read. And now they're saying the combination of these factors, etc. No, you can now proceed. You would notice everything in this scenario is given there. Even the issue of that the directors were taken over by Samba, etc. It's still fine. Like the joining fee paid to Samba's previous directors is a once-off fee by Pelo. Consistently, it is included in consolidated profit or loss. A similar amount was paid by Samba in the form of annual bonus in the year. Therefore, 20x are comparable, but the joining fee represents cost saving for Pelo in future years. Are you not seeing the decline in interest coverage to be driven by both decrease in profit margins and increase in finance costs, as Samba has a large amount of debt and much lower interest cover than the group, this would increase in future periods. That's what I was saying. To say Samba has got low interest cover, meaning it has got a higher debt. So if we dispose it, it means a group interest cover will increase in future. So all these are possible points that you'll be putting across. You get that? All right. Okay. Oh, so this is now another question. Let us jump to another question. Okay. The following extract is from the trial balance of Vernon Company at 31 December 2008. So I will be a bit pacey because I want to finish at 12 sharp. Cost of sales, finance cost, revenue, etc. So there's quite a lot of things there. And then notes. Vernon made large sale of goods on 1 July 2008, which was also the date of delivery. Under the terms of the agreement, Vernon will receive a payment of 8 million on 30 June 2008. Currently, Vernon has ordered 4 million, has recorded 4 million in revenue and trade payables. The directors intend to record the remaining 4 million in the year ended 31 December. The cost of this sale has been accounted correctly in the financial statements for the year ended. Vernon's cost of capital is 8%, which is appropriate discounting factor. Now notice, we sell goods for 8 million in this year, and we deliver these goods, but payment is to be received in future. Now, if payment is to be received in future, yet you have already delivered the goods, does it mean you have to record half of the revenue? No. If I sell goods for 8 million and you pay me half, and you pay me the balance, it doesn't necessarily mean I say my revenue is 4 million. Revenue, I record it in full. The balance, I will put it in trade receivables. So here it's wrong to say Vernon has recorded 4 million. They have to record the figure there. Now, appropriate discount rate is 8%, because what they are saying, the appropriate discount rate is 8%. You know what? The 4 million that you receive is this. The 8 million is to be received after a year. So you can discount and record the present value of revenue, the present value, and then unwind the interest later. You then unwind the finance cost later. You do not receive it, like what we have done there. That if you are going to get after a year, what you have to record at present value and then finance cost as you unwind or as you approach the year. Vernon also sold goods to an overseas customer. So it sold goods for 12 million chromids. So this is the current of that overseas customer. For a 60-day payment term, no entries have been made in respect of this sale, though the goods were correctly removed from the inventory. The amount remains unpaid at 31 December. So this is the exchange rate. So it's like you have sold goods to South Africa and it's in rands. Remember, you recognize revenue in dollars. You use this exchange rate to convert the foreign currency to your domestic currency. And then if the goods are not yet paid, as you shall notice, you can calculate exchange gain or loss if the exchange rate has moved. Vernon acquired 9 million 5% bonds at par. Interest is receivable. Now they are saying acquired, meaning this is a financial asset by the word acquired. Interest is receivable on 31 December of each year. Vernon, in case issue costs, remember this is financial asset at amortized cost, so issue costs are capitalized. I told you that, which has been expensed to profit or loss. So issue costs, they are saying they've been expensed to profit or loss. It's a wrong treatment. Issue costs are actually capitalized. They are added to the cost of the asset. These bonds are repayable at a premium giving an effective rate of 8%. So 8% becomes finance income because these are assets. Vernon has recorded interest received as investment income, meaning it recorded 5% of 9 million as investment income, yet the amount which was supposed to be recorded is effective interest. Are you not seeing? The whole paper full of the same thing. During the year, Vernon revalued its head office for the first time, resulting in an increase of 12 million. Deferred tax is 25%, so there's temporary difference here, which is deferred tax of 25% of 12 million. Vernon values its investment property using fair value. The investment property is increased by 4 million. Now, an increase in the in fair value of investment property is recorded in profit or loss as other income. Tax figure in the balance represents over or under provision for the year. You remember, examiner says over or under. It's up to you to know, was it an over or an under provision? You look at where the size it is. It is in debit. Debit means it was an under provision from the previous year. So you still do what we did, what we said. We say provision for the year is 3.2 million. And then you say add under provision from the previous year, and then you consider whether there was a deferred tax or what. At 1 January 2008, Vernon had 30 million equity shares in issue. That's fine. That this information is about earnings per share. On 1 April 2008, Vernon issued additional 5 million at full market value. On 1 January, Vernon performed a 2-for-5 rights issue at $2.40 per share. The market value of Vernon's shares at 1 January was $3.10 per share. Then prepare profit of statement of profit or loss and comprehensive income and calculate earnings per share. Just a minute, I'll be back. Right. I'm back. Okay. So let us answer this. Let us answer this question. The question says, prepare statement of profit or loss for Vernon. So you know what we have discussed today, especially on section C. This is what is examinable. Make no mistake. Don't say, perhaps it may. No. Ratios and financial statements. These ones they ask. It's either they ask group financial statements or ratios. So yes, the deal. So it's Vernon group. Vernon group. Hang in there. Let us finish it together, guys. Hang in there. But before we finish, we do this. We need to perform some workings. So let us have workings. I will have workings on the side here. Working. Just in case. Let us go note by note and having workings. Note 1 is telling us that you just do your workings on the notes. Note 1 is telling us that we sold goods for 8 million, which we are going to receive next year. So what do? What we do is we calculate the present value. PV of, you say, note number 1, PV of revenue payable after a year. I mean PV of sales payable after a year. Payable after a year. Now the PV is 8 million. 8 million divided by cost of capital. They are saying cost of capital is 8%. They've given us the figure 0, so it's 8 million times 0,9259. 8 million times 8 million times 0,9259. What do you get? Equals 8, 1, 2, 3, 1, 2, 3. Well, the figures are in thousands. Let me see. If the figures are in thousands, let us stick to the notation. Yes, thousands, so that it makes it easy for us to add. 8,000 multiplied by 0,9259. It's 7,407. This is the present value of revenue. So you are already told that directors have recorded 4 million. So 4 million was already recorded. 4 million already recorded. Already recorded 4 million minus 4. So what it means is additional revenue to be recorded. So additional revenue to be recorded. This is now revenue to be recorded. So we still have to record the additional 3,470. 3,470. You get that? 9,259. If I applied it right, 9,259. Good. So this is revenue to be recorded. Additional. It's 9. Now, once you record revenue of additional revenue, so in our sales we need to add this. So every adjustment, let me put it in red so that you can see it, so that when we are now doing it, we have to put everything in red. Now, if you record something at present value, it means as time goes, this revenue present value is 8%, is 7,407. But after a year, it will be 8 million, meaning it will increase by interest. So here what you do is you unwind finance interest, unwind finance income. We are just going to unwind finance income for 6 months from 1 July. Make sure you take note of dates from 1 July to 31 December. Let us unwind finance income from July to December. That's 6 months. So it's a matter of saying 8% multiplied by 7407,2 times 6/12. This finance income, it's other income, which is this multiplied by 0.08 multiplied by 0.5. That's 6/12. So 296. So 296, we will add it to other income. Are you following yourself? Each time we record something at present value, it means as time passes, it will increase to 8 million. Because this is the present value of 8 million, meaning after AA, it will be 8 million. So it will grow by interest, and that interest will be added to other income. So this is like other income. Other income. Then you move on to next. These are working. So workings, your workings should be equal to the number of points you have. Venom sold overseas goods to an overseas customer for 12 million chromits, and we are told that no entries have yet been made to record this sale. They have not made any entry for this sale. So in other words, it's still revenue, but they are saying goods were correctly removed from inventory and expensed in cost of sales. So they are yet to record revenue. So you say foreign sales. Sell goods to your foreign customer, you don't record it in Pula or you record in your currency. So you say revenue. So you say it's a 60-day sale. So it's revenue and receivables, because you credit revenue and receivables because we sold on you credit revenue and debit receivables because we sold on 1 December for 60 days, meaning it's yet to be paid. But this one is less than a year, so there's no need for present value. Present value is only done for a year and above. So it's 12 million. Exchange rate is saying 6.4 per dollar. So you can tell here that chromit 6.4 give you $1. So if you are converting from chromit to dollars, you must get fewer dollars, because $1 is 6.4 chromits. So if you are converting 12 chromits to dollars, you should get fewer dollars. How you get fewer dollars? You divide by 6.4. So revenue, you simply say 12 million divided by 6.4 chromits. So what you get equals, put it in thousands, 12,000 over 6.4. So it's 1875. This is another revenue to be recognized. I'm shading it in it's another revenue we have to also add. And then now at the end of the year, the exchange rate is now 6. We want to see carrying receivables at year end. Receivables at year end. Now at year end, receivables is now 12,000 over 6. Remember, what you do is if a monetary item is yet to be paid at year end, you just say you retranslate it at closing rate. Let me put it in simpler terms. Suppose we are expecting to receive money in chromits at year end, and we say, how much is it in dollars? You don't use the exchange rate that was there when we sold. Otherwise, you are misleading. You use the exchange rate which is there on the date. That is called retranslation at closing rate. So it's 2,000. So being 2,000, it means receivables increased from 1.8 to 2,000, and this increase is called exchange gain. Receivables, they just increased in dollars because the exchange rate has moved. So this is exchange gain on receivables. Exchange gain exchange gain, you record this to profit or loss as other income. All these are figures that we shall need to adjust. So let me have them one by one. So that's what you'll be doing. Next, as we get to the end, our workings will be over. So number 3, loan notes. Number 3, financial assets. Financial assets at amortized cost. Amortized cost. You now know what we do. We prepare an amortization table. Simple as that. Yeah. A student who has been practicing an exam knows how you go about. Then you say effective interest. And effective int is your finance income, remember? It goes to income, to profit or loss. And then you say coupon. Is based on par value, and then you've got closing balance. Closing balance. So what you simply do is you come to this question and say, they were acquired for 9 million, but issue costs were, initial costs were, brokerage fees were 0.4 million. So I said you add, and they were purchased on which date? On 1 January 2008. Dates are important because of need for time apportioning. So initial measurement, you say, because it's a financial asset, you say 9,000 plus issue cost 400. If it was a financial liability, you say minus. You realize there. Effective interest. Remember, effective interest is 8%. So in this case, it will be equal to 8% multiplied by this. 8% multiplied by this. You have 752, and then you say coupon. Coupon, remember, coupon is given here. They are saying coupon is 5%. 5% bonds, so 5% is the coupon. You say 5%. I told you that coupon is not multiplied on par on opening balance, but on par value, which is equals to 5%. 5% multiplied by 9,000. Not on issue code, no. And then closing balance, you say equals this minus, this plus minus coupon. That's your closing balance. And and then, because we only have first year, I'm sure that's it for first year. Yes, that's it for first year. And then you are told that 0.4 was expensed to operating expenses. 0.4 was included in operating expenses. Yet we don't include it in the, so 0.4 we need to subtract 0.4. And finance income, they are saying Vernon has recorded interest received as investment income. So there are two aspects here. There are two aspects to address in this question. The first aspect is deduct for 0.4 million from operating expenses. This one is not included as expenses. It is capitalized. Are you noticing? We capitalized it. So we have to reduce operating expenses by this figure. And then investment income, we are told that interest received was already included as investment income, meaning 450. So you then say since 450 was included as investment income, 450 was included as investment income, the additional income is, now total income was supposed to be 752. So it's 752 minus 450, which was already included. So additional income becomes equals 752 minus 450. So we need to add this to investment income as well, because they've included 350. Then next note, during the year it revalued properties for the first time. So revaluations, that's number 4. Property revaluations. Property revaluations. Property revaluations. So there you go. It's easy stuff here. There is deferred tax on head office. Deferred tax on head office PPE valuation. Head office PPE valuation. What is deferred tax? 12,123 times 25%. 25%. And what do you get? Equals, you get 3,000. 1/4 of 12 is 3,000. Now, this one is not included. In income tax expense. As it goes to OCI. You remember, this one is not included in income tax expense, but it goes to OCI. But OCI is part of what we are doing also. So we shall take note of that. And then investment properties. Now, gain on investment property, this one goes to profit or loss. Fair value gain on investment property. Fair value gain on investment property goes to profit or loss. Can you imagine, Masli? Suppose I'm answering like this and the examiner says time up. Do you know, out of 15 I can score 11 marks without even preparing the statement itself? Without the statement itself, out of 15, if for any reason the examiner says time up and I'm already here, I can bet you I'm already above 10 on this question. This is what you need to know. But if you then work one question and then you go there and no. Then income tax represents over or under, so there's need for us to calculate income tax expense. That is the last working. Income tax expense 5. Notice all these standards we've been discussing are examined here. Which standard do you say it has not been examined then in this paper? Perhaps leasing. Income tax expense, you remember we said provision for the year. Provision for the year. You must, all this should now be on your fingertips. Provision for the year. And the best way to understand all standards is to do this type of questions. 3.2 million. Provision for the year 3,200. And then you say add under provision from the previous year. Under provision from previous year. Notice it's an under provision because it is on the debit side. If it was on the credit, it was going to be over provision. The examiner wants you to know that yourself. No wonder why they say it represents over or under. You need to know. It's 130. Under provision from previous year, it's 130. So if you add the two, you get income tax expense. You get income tax expense here. Income tax expense. Do we have deferred tax? Perhaps. No, we are told that properties were revalued for the first time, so deferred tax was for the first time. Okay, are you not seeing if time up? Again, I already have my marks, because if time up, all these workings will be submitted right away. They will be submitted. So no wonder why I need workings side by side. Suppose I had put workings well underneath here. Notice, and it's time up. Suppose the workings were here. Are you not seeing? It will submit this whole thing blank. This whole part will be blank here. This the time times me out, and I had put my workings underneath. Notice, my workings are here, and the examiner might not even see them. The examiner may think that you have not answered the question at all, because all this part which is visible to the examiner will be blank. So there's no way the examiner can guess to scroll and see that workings are underneath, yet this whole thing is blank. The examiner may think that you just said profit or loss and it was time up and nothing, you then wrote nothing. Are you now not seeing the beauty of putting workings side on the side? The beauty of doing this is, if I'm timed out, at least the examiner can begin to mark my workings right away, because they are visible to the examiner. Can you comment and say noted, say, on that part? Because most of the answers, some of you lose marks by scrolling 70 lines and then put workings underneath, and the examiner will not find them. Right, on that part, I need noted, say, on that part only. Because you may not actually get, the examiner may not see it. Then you say statement of profit or loss and other comprehensive income. Statement of profit and loss and other comprehensive income. Statement of profit or loss and other comprehensive income. So it's simple. You say revenue, easy stuff, open brackets here now. Or everything, we now have it here. We are no longer even going to read anything underneath. We are now just having it here. Revenue 75,350 plus. You are now saying 75,350. Other revenue 3407 comma 2 plus, or just to the nearest whole number is to find, plus this other revenue 1875 on foreign sales. That's your revenue there. So you come in and say equals 75,350 plus this plus, no wonder why I have my workings, just to relate. Then you say cost of sales. Now cost of sales, there's no adjustment to cost of sales. It's a matter of taking it as it is. Cost of sales, it's 46,410. So you say minus 46,410. That's your cost of sales. And then what you get is gross profit. So this is gross profit. Gross profit. Now you then say other income. So other income is, there's a lot of other income there that we are going to put. Other incomes. Investment income is other income. So the investment income that we have, which is 1520 plus any other income that we have here, and we said unwinding finance cost 296 plus exchange gain 125 plus plus additional investment income 302 plus property revaluation gain 4,000 plus yeah, that's it. All these are your other incomes. Close brackets like this, we put it here and say equals 1520 plus 296 plus 125 plus 302 plus 4. Right, that's other income. And then you come to operating expenses. Operating expenses. Operating expenses. Operating expenses. Operating expenses. Remember, we have operating expenses which are given as 2640. So you say 2640 minus on operating expenses, there is still this figure here, which we say reduce operating expenses by 0.4 minus 400. We have to reduce operating expenses by that, which is equals to minus 20 640. We want to reduce it by 400, so we add. So it's now 2240. And then you then get after this, you get what is called operating profit. Operating profit, and operating profit is where you add from gross profit through to this. That's your operating profit. You can choose even to bold some of the points, but it's still fine. You don't have that luxury as long as your points are in order. As long as your points are in order, then you say finance cost, finance, but always know to follow format. Finance cost. Now finance cost, right? Finance cost, we don't have any adjustment. It's 4050. There's no finance cost and any other adjustment here, equals minus 4050. That's finance cost. Then you get profit before tax. Profit before tax. After getting profit before tax, that's your figure for profit before tax. And then you say income tax expense. Income tax expense. You just put the figure for income tax expense. We've calculated it here. And then you get profit for the year. You then get profit for the year. Profit for the year, which is this. All right. Profit for the year. So there you go. And then you say other comprehensive income. Other comprehensive income. Now other comprehensive income, you then put gains on from PPE valuation net of tax. Gains from PPE valuation net of tax. Net of, it's net of deferred tax, or simply net of tax. So it was, you valued it for 12 million and deferred tax was, so you say equals minus 12,123 over minus 12,123. You say let me just say 9,000. Simple as that. And then you add this together. You get total comprehensive income for the year. Total comprehensive comprehensive income for the year. This is the format. We mark the format, guys. Don't make no mistake. We mark the format. Now that you now have total comprehensive income for the year, this question is done. That's your 15 marks. And unfortunately, you students, you then say, say IAS 1 was difficult. I don't know the strange term you give to this. You then begin to say it was IAS 1. No. This question is not IAS 1. Of course, IAS 1 is about the format of profit or loss and other comprehensive income. Fine. But this is about standards. So from now on, I want you to not to say IAS 1 was no, this is not IAS 1. What is being asked here is the standards. Are you not saying it's standard after standard, standard after standard through to the end? So they don't then say, I'm having issues, say, with IAS 1. No, say it out well. I'm having issues, say, with accounting standards. When you are practicing these questions, know for sure that you are practicing the standards. All these are the standards. It's not IAS 1. You get that? So you need from now on, actually have the coming 2 weeks, desist from doing multiple choice questions over the coming 2 weeks. Make sure you're doing this type of questions because these type of questions, they enable you to cover a lot of ground. Where can I get them? Say, you come to your Kaplan F7 Kaplan kit, say 2020, let me show you. And you just start from, where are the questions? All these questions, section C questions. Are you getting it? All these questions, there are a lot of standards. Calculate missing ratios, excluding contribution from the division. You now understand these. Comment on the performance. You can't tell me that you don't have these at your disposal. They're quite a lot. They're quite a lot. Notice. Yes, all these are ratio analysis. So they change from one question to another. Like these are groups. Prepare consolidated financial statements. Consolidated financial statements. Now, before you come to groups, there is also calculate goodwill and stuff. Prepare extracts from the equity section showing non-controlling interest. Yes, all these are groups. Acquired, all these are groups. So you can see business. But these are cash flows. Do cash flows. Because these questions combine a lot of standards. No wonder why I like them. Like prepare statement of profit or loss for Dagan. Prepare statement of changes in equity. Calculate basic EPS. And if you come here, you notice Dagan began construction of an item. So these are construction contracts. Dagan discovered that there was an error, this fraud. So all these are the notes. Dagan issued 6% convertible loan notes. The tax figure represents over or under. The same stuff here. Dagan was notified by an ex-employee that there was a court proceeding. ETC, these are now provisions and contingent liabilities that we were discussing. Dagan entered in a contract where the performance obligation is satisfied over time. Now, the question then says, prepare statement of profit or loss, and you are saying, I don't know this. Clearly, you can't know this if you have forgotten your standards. Because you don't say, if I ask you, Mercy, where are you having a problem? And you say, I'm having a problem in preparing statement of profit or loss. You are actually saying the wrong thing. What is giving you problem is you have forgotten the standards. So before you answer this video, this question, you play videos on standards, basic standards, which are all covered here. But if you do 7 questions, you'll be super intelligent with all these particular standards. Now, because I want to wrap it up now, basic EPS. You remember what I said when you're calculating EPS. You prepare what is called want schedule. one's schedule. I said date. I'm sure you played the video. No wonder why I always give you videos in advance to play, so that when I'm doing this, we are on equal footing. Remember, I said you say date, and then you say shares, and then I said you say what? Period, date, shares, period, and then what else was done here? There was a rights issue. They made a rights issue of 245. Then I said you multiply by the rights fraction, and then you have got weighted average number of equity shares outstanding. If you have forgotten this, replay last week's video that I sent where I said there's EPS. Notice you may lose easy 5 marks there for nothing. Now, at 1 January, Venon had 30 million shares in issue. So 1 January X8, how many shares did we have? 30 million. So let me put 30. It is recommended to put all the figures. 30 million. 30 million like this. And you ask yourself, there were 30 million for how many months? Until there were 30 million up to 1 April, meaning there were 30 million just for 3 months. Just for 3 months, which is 3 over 12 equals 3 over 12. So there were for 3 months. And because these were before rights issue, remember what I said, we multiply them with the rights fraction. So what you do is you calculate rights fraction. If you're calculating rights fraction, if I can skip lines here, I say rights fraction equals rights fraction equals, you remember I said price before rights issue over theoretical price before I divided by theoretical X rights price. So theoretical X rights price, how do you calculate TEP? TEP is a matter of saying, when you're calculating theoretical X rights price, you say there is before, then we have got rights issue, and then you say rights issue, and then you say after. So I'm going to come to this, but let me proceed. So the ones you say 30 million multiply by period, multiply by the rights fraction, you get the answer. Then you come to the next date, which is 1 April. What happens on 1 April X8? You issued 5 million shares at full market price. So there is 5 million shares at full market price. Now what you do is, after issuing 5 million shares, if you play that video nicely, you do notice I said at each transaction you add to get the total. So how many shares we now have 35 million shares, and they were 35 million for how many months? From April, May, June, because on 1 July there was another transaction. So they were for 3 months, equals 3 over 12. And then we were yet to issue rights issue, so there's need for rights fraction. And then on 1 July X8, what happened? There was a rights issue, and this rights issue was 2 for 5. So it's 2 shares for 5, so equals, you come here and say equals 2 over 5 times the shares that we had. So 2 over 5 times this 35 million. And what you do, I said you add 2 over 5 times 35 million is 14 million. Yes, I suppose. I add this up. I am now at 49 million. Then I ask myself, there were 49 million for how many months? There were 49 million for from July to December for 6 months, for equals 6/12. Then let me calculate now rights fraction. So before rights issue, how many shares did we have? So I ask myself, before rights issue, how many shares did we have? So you say shares. Before rights issue, here I had 35 million. Like this. Rights issue brought how many shares? 14 million. Or you can just put it like this. This is easy. An easy approach is to say, if it's a 2/5 rights issue, 2/5, you can simply say before rights issue he had 5 shares, and then rights issue brought 2, and then after rights issue you now have 7, and the price was price or value. Let's say price. Market share value of shares before rights issue was $3.10. So price, I put $3.10 here. $3.10. Rights issue, I issued the rights issue at rights issue shares were issued at $2.40. So I put $2.40 here. $2.40. And then value. So before rights issue it was 5 multiplied by $3.10, $15.50, and then here what I then do, I add this up. Because I want to calculate TAP. Remember, TAP means the price after rights issue. So TAP is the price after rights issue. That's theoretical X rights price, which is TAP. So in this case, my TAP becomes equals 20,3/7. So this is my TAP, 2,9. Now, if my TAP is 2,9, it means my rights fraction is price before rights issue over theoretical X rights price. So it's equals to $3.10. That is price before rights issue divided by 2,9, which is theoretical X rights. So this is my rights fraction. So here I multiply by rights fraction because all shares which were in issue before the rights issue are multiplied by the rights fraction like this. But after the rights issue like this, not applicable. So you then have to multiply again to say equals this, multiply by this, multiply by the rights fraction. There you go. Here equals 49 multiplied by the period, and the rights fraction is not applicable. Therefore, weighted average number of equity shares outstanding is this. This is the weighted average number of equity shares outstanding. Undo. Weighted average number of equity shares outstanding is 41,876,89. So when you are now calculating EPS, you then just say EPS equals EPS. The question said basic EPS, I'm sure. Calculate earnings per share for the year. So you say EPS equals attributable earnings over ones. Please familiarize yourself with this knowledge. And by attributable earnings, we are saying profit for the year, not total comprehensive income, but profit for the year. So we are saying profit for the year divided by profit for the year divided by weighted average number of equity shares outstanding, and see what's your EPS. I said equals profit for the year. Profit for the year should be in thousands or in millions. So profit for the year let's say put profit for the year times 1000 to bring it to millions, divided by weighted average number of equity shares outstanding, which is this. So it's 31 cents or 29 cents, which, or I mean 31 cents. You put it in cents. So a basic EPS equals 31 cents. I know I might have rushed because I need to make a call now. So here is your to-do list. If you have got issues with EPS and computation of weighted average number of equity shares outstanding, please replay the video. Replay this video, guys, that I sent last week. Where is it? I don't know if I can come here and begin to scroll up. Let me scroll up. Well, it's not scrolling. I don't know why. All right. I wanted it to scroll, but I'm sure you have it. So it's, oh, sorry, it was scrolling. So it was sticking for whatever reason. Right. This is the video I'm talking about. Earnings per share and IS1 question practice. And you'll notice in this question, we then did statement of profit or loss, statement of financial position. Make sure you play this and make sure you then get your answers right. So with this in mind, yes, let me end here, guys. I have another call to make. Enjoy the rest of your week. Yeah, you know, there's a lot of to-do list in your plate. You can't tell me that you can rest now. You have to do quite a lot of things. Cheers. You have a good day. Enjoy the rest of your day. Pleasure.